So, what are we looking at?
Well, this is an Excel spreadsheet. So I call this it got nicknamed the crystal ball because everyone's like, no one has a crystal ball in the markets. No one can see the future. And I got way too OCD with this. So if we dive into the what if game where it started, when I was actually quoting Richard, this thing, let me show you as I zoom out the size and scope of this beast.
Oh, wow.
So at full zoom out, yeah, you start to realize this is a 20-year model. And I have to make this thing so much bigger to be a lot more accurate. And so in the gist of it, I had to look at a whole bunch of mathematical things. So, okay, what did I look at? I had to figure out the liquidity pool size that would exist for the asset. So that way I could figure out how it's going to be affected. And the liquidity, actually, I still have to do some adjustments. That number needs to be twice as big. The liquidity ended up 2 trillion tokens, which I never anticipated. So I've got this model adjusted to the wrong size. Let me see if I can get that right here, because I threw in a scaling option because I had to with testnets. There we go. That's about the amount of tokens. Well, actually, to start, yeah.
So, very briefly, before we continue to delve further into it, what were you hoping to achieve with the creation of this?
Well, everyone was calling the buy and burn a gimmick. They didn't understand why it should hold any value. They were essentially calling it a tax on people. And I wanted to prove mathematically, step by step, so that people wouldn't argue that, hey guys, look, this is the revenue. Uniswap charges these fees too, and even more. So it's not a tax imposed. Now, here's how the buy and burn works. Here's how you can see supply disappear over time, which means less to dump on your head over time. This is how you can see how it can affect price because of how liquidity pools can function in Uniswap v2 and PancakeSwap and all the rest. So I built a liquidity pool, and basically, like, because that math is as simple as X times Y equals K. All right. So one side of the pool is. Say,
I'm already intimidated. Just
Pardon?
I just want to say that I'm already intimidated. Once we get into multiplication division,
okay. Well,
that's where I start to get scared.
This is where the model starts. Is say you have a pool with 10,000 tokens, and then you have 10,000 stablecoin tokens. So $10,000 on the other side. Oh, sorry, that's our multiplication thing. 10,000 on the other side. Well, you get a constant number. It's kind of like building a seesaw or teeter-totter on top of a base. So, equals our first pool multiplied by our second pool. It's that simple. This number right here, let's give it some commas, a format that's easier to see for people. There we go. Now you guys can easily see 10,000, 10,000. So essentially, whenever you do a trade on Uniswap, this is how slippage works. This is how a Uniswap trade on V2 works. Let's say I see this token, and we'll call this Furby token, just because Furbies were obnoxious crap. And I see this Furby token, and I see that it's $1 a token. I think it's a good buy, and I have $10,000. So here's the stablecoin side. Here's the token side. Okay. So I have $10,000. I think that's a great idea. So I'm going to go ahead and dump that in there. So that makes that $20,000 now, right? Well, it doesn't change the K number. The K number has to remain constant. So it doesn't get me 10,000 tokens. Essentially, 5,000. Oh, there's our K number. So what I did was spent $10,000 and only got $5,000. Now there's $20,000 and 5,000 tokens left in this pool. So the price was $1 a token, but now if you divide, so this equals the money divided by the leftover token supply. Look at that. We have a price of this token of $4. But we go over here and replicate this exact same trick with what we spent. Sorry. C, Control V. And look at that. We paid. Oh, I moved it down. Just get up to the same row. Whatever. You guys, that's the whatever.
Sure.
$2 is what you paid. So price was $1. You paid $2. That's the slippage. That's how you get affected with the price moving around you as you're putting it up. And then this is the price afterwards. So the current balanced ratio. Because the base underneath always has to stay the same, at least in the V2 of Uniswap model, the X times Y model. So small liquidity pools can be very brutal for slippage, and that's why we want to see much larger pools for much less slippage, so that a $10,000 buy doesn't get 50% slippage. So that gives you an idea of liquidity size and how a pool works. So I had to figure out some math and figure out, well, if I change one side of the pool, I need the other side to automatically change. So essentially, okay, then I can make my pool, since I know the number is 100 million, make it the static number. Okay, so I make my 100 million the static number. Now I can just put in my dollar amount and make this field equal. So I'm playing around with Excel, and I realized, well, I need all three of these to be able to move around. So essentially, I eventually built the math for what I call here are these cells, the month cells. These are the liquidity pools being run at the beginning of the month, the buy that's happening from the buy and burn, and then the resulting pool after the buy and burn. So by stacking these functions in a row in a certain order, I get to be able to start making adjustments to either side of the pool, or to even increase or decrease the K number, which is what I was doing with that first variable up here in gray, in order to go back here and increase the token supply as I'm adjusting basically all of the liquidity math. And one of the insane ways I can show that off, which will make people cringe, is right here in cell A17. Here's some simple algebra for you. So I try not to flaunt or get in front of people. Like, I realize you can get lost in the weeds. So simply enough, this field right here, the orange field under the second column under B, is always showing the buy amount that the buy and burn is executing, depending on the variables that I put into that. So then I looked at Uniswap as the base model, the amount of volume it did daily. And then I set a bullish in terms scale so I could adjust to that. And I assumed, what if we could do about 10% of their volume daily? I mean, we're doing 20 million daily volume in Pulsex right now. And right now, like, that is a lot less effect than we expected to see. Like in the first month, we were hitting, and this is where I had not anticipated the first month to be so ferocious with volume and then peter off. So I had built it as an S curve, and that's a whole different model up. But I included an S curve in my model, so all the volume starts low and runs up. So I have to almost ignore the first month with this math model now and go from the current point. And I'm going to have to go back and retroactively add the insane first month of volume into the math model with some static information for it. And I haven't had a chance to do that or think about how to do that. Again, I'm trying to scale a business. I don't have time to be building this model in such detail, where this is me doing this by a month-by-month basis. There isn't one buy and one sell per month. It's happening on a daily basis. So as I just showed how slippage over in the garbage data can be affected, Well, I'm having one huge buy go off from the buy and burn that eats a lot of slippage. So it's not an accurate show of how many tokens it might have gotten day over day, where people might be selling day over day, keeping the price low. What's actually happening right now. And I have all my sell-offs happen at once with huge slippage because I'm only doing it monthly in the first. So monthly, 12 times a month, well, or 12 times a year, there's 365 days a year. I would at the very least have to be doing it weekly, which is 52 times instead of 12. But I should be doing it daily. So like this model has to essentially get, 12, 360, like it has to get 36 times bigger on just the first year. And then essentially I have it go year after year in the model afterwards. And this essentially has to get increased to at least weekly if I want to have something roughly accurate, because buys and sells are happening by the hour. And this is where the slippage is not tracked right in this model, but it does over on the crystal ball start to give us some projections. And I did build some graphs to kind of show us. So the variables it started to look at using Uniswap as the base model, I'm like, okay, true burn rate was when we got different testnet after different testnet. There was speculation about changes in Pulsex. I kept adopting the math model. Ignore that. Adoption rate, though, this is where I put into the S curve. I have this at very low. So 105% means next year there will be 105% of the users there is this year, only 5% growth year over year. Now, even on the exponential table, when you looked at the sacrifice rate for Pulsex, you can see what 5% growth could have, but that could take 30 years. So the internet grew at a rate of 71% year over year. Crypto is growing at a rate of 114 year over year. Like when I say 71, I mean 171% of the year before the internet.
Right. That's what people got to understand. There's a compound effect.
Yeah, crypto is doubling every year. So this is me really lowballing the numbers. I have now cranked the liquidity up to about matching the actual supply we have, which is a giant K number. Here's where I put the LP size. So I had originally had a starting price. I think that is now accurate. I have adjusted that starting price to relatively where it came out of the gate swinging, at least pre-bridge, when Pulse was equal to Pulsex, and Pulse was approximately that price. It was based off a whole bunch of things. It's just approximately a good starting place for me to use. And then I'm like, all right, so say I put $100 in. Now let's say we are doing 10% of Uniswap's business year over year. The idea there too is Uniswap had about when I was doing this, building this, a base user of about 1.5 million users or 1.5 million active wallets. So assuming it had 150,000 users to start, 10% of that, 10% bullish in terms, I started tracking user growth at the same time that I was tracking basically the idea of revenue growth year over year. So on a 5% timeline, this middle column tracks user growth. So at the end of 20 years, we're still only at 400,000 active wallets. That's really piddly. That's really stupid. There's no way we're going to be that.
These are very conservative numbers, yeah.
That's stupidly conservative. So let's at least put that at 10%. We go down to the 20, and we can see we broke 1 million. We could break 1 million in 20 years? I think so. That's still conservative as hell.
I think we break 1 million.
There's people rolling and screaming, going, crank that up. I'm like, no, not yet. Yeah. So in here, one of the factors too that everybody game theory wise screamed was how many people got in on the Pulsex sacrifice just for Pulse? How many were going to trade it off, and what kind of damage were they going to do to it? What kind of price dump were they going to have? Well, we've seen the price dump. 8% doesn't cover it, because dropping down to the price is lower than that. I'm going to have to do first, I'm going to have to expand the number of digits in this row. Okay. So now I got to crank this number up. Well, how does 12% get us? Nope, the price is lower than that. I had to use 20 a lot of times. Let's get to 15. Oh, price is lower than that. Let's get to 20. That was my favorite number. Oh, isn't that interesting? That's pretty close. Let's crank her up to 22. We've gotten down to that on a dip. But this is assuming the huge sell-off that maybe now, okay, 22% of the stackers want it out right off the bat.
Mm.
They dumped maybe an extra wow, or I still see it. No, I got to go back and really look at the numbers because I'm just doing this by the seat of my pants.
Sure.
And I got to see where the liquidity actually started and how people have been removing and adding it, because I'm not sure what this is doing to the liquidity numbers, because I'm pretty sure another 3 trillion tokens didn't really hit the market, or if they had, they've been scooped up.
Can I ask you something real quick?
Because the price didn't go lower than that, right? And I'm not now, interestingly enough, I did finally admit to people, this is still the sell-off. I had sells just dumped in here over and over and over. Let me get these out of here, because I am simulating market sells, because I'd rather do that than market buys, just to show you how powerful the buy and burn is. But like down at the bottom, you can see a series graph. Okay. And I have an adoption curve graph down here that's really modest. And I can get into the 5-year graph where you see price recovery, and even the 20-year graph. And on this very mild model right now, it would suggest that we could still see a 100x in our value over 20 years. And over 20 years, we've seen the devaluation of 95% of our currency. So like that alone says the buy and burn should outpace the rate of inflation devaluing our currency. That's a valuation I can get behind with some of the most conservative numbers ever, where I don't care where it moves to, because I'm looking at these buys over and over affecting the market in this way. But realistically, I do think that we will see a lot more adoption than 10% year over year. So we could crank that up to 120% year over year just to be light. And I have an S curve modifying that adoption, but it does get us to about 5 million users after 20 years. But more so, what's important, 5 years, we're approaching over 500,000 users. That's kind of some impressive metrics, and suddenly it changes the future price of Pulsex a lot.
Now, is this just assuming just the effect of buy and burn?
Yeah, this is assuming just the effect of the buy and burn happening.
Now, that's a very big deal, because if you incorporate more buying than selling on the whole, then that's just even increasing these numbers.
Yeah, so essentially year over year, the variables that go into this are, at what rate is adoption occurring? Overall, what is the revenue level? And then I look at it like where I was just proving the functionality of how the buy and burn will compensate for people selling off and dumping into the price. Because in this model, like right here, you can see my projection. This insane model with no one buying off the open market except the buy and burn gets to destroy 3.2 trillion tokens. But this assumes that not a single person in the world is buying or DCAing into Pulsex.
And that's over the course of the first year, you're saying?
Yeah, and that's the first year. And then it shows what this would do to price if that's the case. So I just make sure I have removed all the cells. Was I tampering with this at all?
And that's extremely significant, because over the course of the next 2 years, next bull market here, based off some of these numbers, we're looking at maybe 6.5 around there trillion being bought and burnt. And people got to consider that the total liquid supply is about 21 trillion. So that is a not at all insignificant portion of liquid supply. That is a very significant portion of liquid supply here that's being bought and burnt. That's very interesting.
Yeah, and that's still like with this 10% user base like of Uniswap idea. Yeah, And this is still like such low metrics. Like realistically, I mean, crypto is adopting where it's almost doubling year over year. And I'm saying that one of the cheaper, more gimmick dexes that could have more feature coming to it, like the volume that's capable. I don't know. Like I believe in S-curve adoption, so I have it ramp up slowly through the year with its power. And if I go to the what if game in here and actually look at how this is running right now, essentially this is actually really lowballed it, because this isn't quite right. Because right here we can see the burn, the buy pressure, because also this math model wasn't including dexes that were running at full burn instead of running at, oh, we're giving about 20% of our stuff to burn. So
Right. Yeah.
this has been kneecapped because our first month saw a lot more than $2.9 million of buy pressure. So I still have to crank up this bullish in terms a little bit to get that matched up. And I think I got to crank it to 20% because of our V1 pools. Because I've got to go back and adjust the math, because here I have that 21% and see, like, it's part of it, like actual programming that I started to do in Excel. So changing that number, I got to go adjust it later. It's easier. Hey, look, $5.8 million. That's a little closer to what's been put into the buy and burn. And essentially, even with the massive sell-off we have that's dumped price to this exceptionally low number, with the buy and burn chipping off of it, we essentially can see that, hey, by the end of the year, we could get back over the sacrifice price again without a single other person other than the buy and burn chipping away at it. But that's where it has this price staying. Like, let me get into month 8 and expand that so you can see the price, because I never contemplated prices quite this low.
And
So,
that
yeah.
presumably helps out the situation, because the lower the price is, the easier a time the
Yeah.
buy and burn has burning supply.
So yeah, I hope you can see this okay, where I'm expanding these numbers so you can see 3 digits of price. And you can see where, what's our current price right now, Brendan? I haven't even looked today for Pulsex.
40313.
So here's 40315 in month 2. But and okay, we can see it goes to 337, 3. So what the heck? Why? Yeah, 359. Yep. Then so this is slow. So month 6 months in, the buy and burn working alone without anyone from the market buying, if all the sellers stopped selling, could restore price already to 4 zeros and a 4. And again, no further selling or buying in the market. And let's see here, month 9. Month 10. Okay. All right. So there, month 12. So we're not actually back. Once we've expanded this, we can see it's actually a little bit slow recovering this. But hey, this is just the buy and burn working. This is where it's like, wow, you don't have to count on the next person to buy it to push the price up. Something is actually buying it, pushing the price up. So let's go ahead and make sure where it is now. Here we see by the end of year 2, the buy and burn has recovered above the sacrifice price for even the poorest of us. If they just have the patience and stop selling right now, the volume on Pulsex, the fees collected, could potentially do this just by the second year and get it above the sacrifice. This is not as moony as people used to love when I was looking at it. But if we jump ahead and we get to 5 years in the future, again, the buy and burn chipping away, you're not betting on market speculation the same way. We're at 2 zeros and a 1-4. Like, we have done a 12x above sacrifice price at the end of year 5.
Whoa,
essentially.
okay. So hold on. That's huge. So you're assuming if volume continues to, uh, you know, expand at kind of a similar rate we've been seeing, that after 5 years we could be looking at a 12x over day one stack rate.
Yeah, and I'll go through the what if game here and show you. So yeah, this is where, wow, yeah, okay. So yeah, I expanded this to 7 decimals past the 0 for these. So realistically, yeah, we see our current price, and then here we can see a 1 in front of that current price by the end of year 2. So that essentially is a 4x from where we're at now, but a 1.13 from sacrifice price. And yeah, it could double by the next year. Like, we start to almost see a doubling effect to the price year after year from that. It's pretty impressive here. So yeah, I have to keep expanding these to make these look, yeah, 7 decimal places for all of these. So yeah, realistically, we're looking at 5x's by the end of year 4 and 12, more than doubling by 5 the way I'm doing my S curve. But let's look. So the graph kind of projects, you know, coming from this sub-zero range to getting to a tenth of a penny. Yeah, getting our 10x just from the buy and burn. And this would be with not adoption buying the token, but just using the DEX, using the chain, essentially. All the arbitrage coming through at the increase in volume should be able to have this kind of effect. And yeah, I really love this. So in this model, oh, oopsie, that's a typo. Here we go. That's 5 years. That's 5 years that's looking at. Over here is first year. So 1.6 trillion in the first year. My apologies. This is meant to be attached with this graph. So first, since first year. So yeah, first 5 years.
And not to mention too that the more buy and burn there is, the smaller and smaller and smaller the pool of potential supply that is available to buy there is.
Yeah. So we'll look at how the liquidity pool changes over time. So if we jump to 6 months, and we can see, like, in this, I think I have to readjust because I think we're currently sitting at a liquidity of 2 trillion tokens, which is why I'm a little off in my math, because after all the sell-off to get us to our price, we should be sitting at that token supply. So we probably were sitting at some lower liquidity. But because I don't think we have this much in the supplies, I'll have to go look in some detail.
Go to
so busy.
2.2.
I haven't gotten to update this math with the actual models that are going on. I just get to poke at the numbers and see it's running as intended and be so happy and gleeful.
Dude, this is extremely interesting. What I would love to see, sorry to interrupt you, but if someone could like fund you and see if we can get like API keys for you to like get live data that you could feed into this. I don't know what you would need, like an Oracle, an API, what it would take, but wouldn't that be super interesting if we can somehow like plug in live data into this so you can like query the blockchain and like see in real time what the numbers are? I don't even know if that's possible, but if we can get those live numbers, that'd be very, very interesting. New sacrifice people.
Is there a reason I had this balanced like this?
Folks, in the meanwhile, like and subscribe.
Right.
This is very, very interesting stuff. Yeah, no, these numbers are incredibly, incredibly interesting. Because guys, like this is an in-depth model, but we're talking about very large numbers being built.
Okay.
Yeah, go ahead.
My apologies. So I remember why I had it set at 8% and 800. So originally when I built this model, I thought Richard Hart likes small liquidity, so objects go up. So I copied the liquidity pool Hex was using, which is where the 1 starts on this. And I had it set to 250 because I thought, you guys are animals. Every time I looked at testnet, the liquidity was bigger. It got 250 times bigger. When I got to mainnet, it was 800 times larger with nearly 1 trillion tokens. About 8% of the supply dumped in, approximately 1.3 trillion or more, because some of it got market bought out, but that's the minimum amount that got bought in. That puts us at about 2.2 trillion tokens in the supply. That gets us, yeah, that's getting more to what happened. Let me tweak this just a little bit. There, I think use 12%. Because then tokens got scooped out at large supplies. So, sorry, I'm adjusting the math again. 1.3 trillion tokens is what this model would run like. And there we go. Price starts going up a little bit faster because the liquidity is not as saturated as I thought it was. Like, that was insane the way I cranked it up. That liquidity pool size was a scientific number that was ridiculous. 2 to the power of essentially 20 is already an insanely big number. Here we go. End of 5 years, 45 X's from the buy and burn. That's the kind of minimal stuff I'm counting on. So yeah, if we get into the what if game, now the pools match a little better. So we've had some market buying, but we can see we go very quickly. Month 3, some market buying. It hasn't gotten as bad as 2.6, but my numbers are better here. And essentially, that many tokens available for sale in liquidity by the end of the first year, we're down to just 1.5 trillion tokens available in liquidity. And that's if no one in the market is buying it to make that number smaller to push price up.
Whoa, could you repeat that, please?
The buy and burn is chipping away at the tokens in liquidity, and that no one else is adding liquidity, no one else is selling. But we get under 1 trillion tokens by the third year. The second year is 1.5, and the third year, yeah, we're already at 800 million tokens in the liquidity pool.
That's huge.
So the basically the crystal ball has a harder time, or the buy and burn has a harder time stealing tokens to sell them. So yeah, in the first year, another is a whole 1.3, but then the next 4 years, that's what this needs to be. The next 4 years, when you built a thing forever ago and haven't looked at it in months, you forget. The next 4 years, another 1.2 or almost 1.3. So it takes 4 years to do the burning that the first year did, because price is going up as volume's going up with adoption increasing. So we see a slowdown actually in the number of tokens. This is where you were wondering if we could see a straight line projection. And this is where, okay, without the market even buying, the buy and burn pushes up the price bad enough on liquidity that it can't do a straight line, that eventually the price will go up unless people keep dumping. So right now we've seen probably over 10% of the sacrifice dump into the supply. So what if after we start to recover some value and return to the sacrifice price, let's say we just step in right here, what the hell, month 10, and we dump another 1.7 trillion tokens on the market, dump 10% of the supply outside the sacrifice. That's enough zeros. No, that's only 1.7 billion, isn't it? I need. There we go. So if another 10% drop happened in month 10, let's say, so now 20% of the tokens have been dumped. The price by month 12 is about where it is again. We can see on the price chart this big dump down, but then it starts slowly picking back up. We would instead see 1.8 trillion burned in the first year, and we'd see more tokens burned in the next subsequent 4 years at 2.4 trillion tokens.
Can we look at the first 2 years? Because in my opinion, I think we got 2 years of bull market ahead of us. Obviously, it could be longer, but I think roughly 2 years.
Yeah, this also isn't anticipating a bull market or anything pushing up price. And I'm still not doing, because if market buys start gobbling this up, it slows down what the buy and burn can remove, what it can essentially destroy. But it doesn't slow down the amount of money it's dumping in. So it will always keep dumping in. So After the third year, in an entire year, it could exert $145 million of buy pressure in its third year with the current model I'm looking at.
That is
Money
really
is going to
significant.
come in one way or another. The question in this model then, like, it's not looking at market buy pressure. Will it be able to destroy this many tokens? Will the price be at that? And that's, again, assuming that we keep up with a S model that I built that doesn't incorporate bull market cycles. So this doesn't actually look at what the bull market's going to want to do to it. This is more of a Wall Street style valuation at the base power of revenue and how much revenue could be applied to a liquidity pool month over month or year over year. So I have a bunch of different variables to basically resize the revenue, and those two variables are based on how bullish are we in terms of Uniswap and how much adoption do you think we could see year over year? Because realistically, if the internet adopted at 76% year over year, and I mean Bitcoin alone is adopting, crypto essentially adopting at over 114% year over year, which is 214 if I were to put it into this model. I only have this at 120, or aka 20% year over year. Let's see what 40% looks like year over year. Wouldn't that be a great number? Let's have a look at 40% year over year. So let's see if this is plausible. By the fifth year, we're at 4.5 million users. We break 10 million users in 11 years. We break a 250 million users by 20 years with this kind of math and adoption. Some people in the audience probably go, man, yeah, that's plausible. Like, I don't know, but I threw in the possibilities so you can look at your idea here. And when you get that kind of pressure year over year with growth from the model, now you can see our third year is over $231 million instead of $145 million of revenue applied to the liquidity pool. That's quite a sizable impact. By the fifth year, are we applying by the fifth year, we start being able to dump over $1 billion of buy pressure, buy burn into it.
Just 1.2 roughly.
Yeah, just 1.2. And I mean, that's a guaranteed buyer in the system. You really need me to do day over day stuff and show you now, if we show people buying like they are, what that does to price. Yeah, price is going to go up because, hey, look, now the buy and burn by itself, fighting two massive sells, one that's we're saying happened and one that could happen, another massive panic sell-off for whatever reason. And at the end of 5 years, we're looking at 222 X's from the sacrifice price. From the end of the second year, with no one buying in the market, no one pushing the price up, no mania, just a 2.7x from the sacrifice price. But wait, if you act now, we'll double your order. There's more. Here's the 10 and 20-year forecast, the heart attack material. When some people start going, wait, what are the X's on that? What did your model just... What if 250 million people were using Pulsex in 20 years? What could a token be worth? A Pulsex token could be $718 per token. What? Number of X's are sitting at 7 million since launch. That's kicking Bitcoin's butt in 20 years. That's assuming it doesn't get replaced, end up obsolete, get hacked, all the what if game horrible things that can happen in the future. Because as it says in great big red letters, warning, this is not financial advice.
Right.
All right. This is only in theory. This is just to show you potentially in conditions, because I haven't plotted every variable.
Yeah.
So no market buy. But then I admitted, I was like, oh yeah, the whole time I actually lied to you guys because, oh wait, coins purchased right here in the what if game, the original model I built, there's the market buy, and then there's the market sell. So the crystal ball just transfers it over. So if I just go ahead and say, take this black, and I make some font on it, Let's say white, and then, oh yeah, I can include a buy amount. And oh, look at the price. It, like, long term didn't seem to affect that $10 million buy, didn't seem to affect price long term much, especially when we know in the future there's a mega sell coming on that head. But in the midterm, we see, ooh, a little extra hump earlier in the graph.
Mm.
So yeah, there is the capability, but like, it turns into a huge mess, and it doesn't do slippage, and it's not really supposed to. I don't want to be the price guy, guys.
Sure.
I
Sure.
just wanted to show why using real financial instruments that Wall Street uses to take tangible value, revenue, and distribute it to the holders to give it a actual reason for it to be valuable. This is one form of redistributing value by taking the tokens and deleting them so you can never sell them again, and just giving the revenue to investors by dumping it in the liquidity. And the other way is to skip the liquidity pool and just give it straight to the investors so they can decide where they want to put it, like time dividend does. And so that's essentially the insaneness of the math. Now, if everyone wants to get heart attack worthy and assume that Elon Musk is getting Pulsex, Tweety, and Allcoin Daily, that we're going to kick Uniswap's butt. We're going to go to 50% of their potential. And you know what? We're going to get to that 175% adoption like the internet did year over year. Here's your heart attacks. Here's your math I don't believe in. All right. This is your future speculation. So our 5-year alone says under these conditions that we could see a 26,000x from the sacrifice price. It would be 100,000x from today's price, probably.
What about year two?
Yeah, and then if we skim on over to the 10-year forecast, we're looking at, just in 10 years, $316 per token. That's right, a 3 million X or a 10 million X from today's price. And in the 20-year forecast, that's right, $23 bloody million per single effing token. This is if no one sold in all 20 years. But how could no one sell? Everyone would want to take freaking profits. Well, it would create the worst bubble in the world that would not be unkin to Luna, but it would be possible because of the Earn protocol. You can just mint stablecoins to take profits from your Pulsex. You don't actually theoretically have to sell it, peoples.